We believe perspective is everything when it comes to your finances. Today, we give you some perspective on why you should continue to hold bonds in your portfolio, even though they've recently dropped in value. Hello, I'm GenWealth co-founder John Shrewsbury, in for Scott Inman, who's wrapping up his spring break this week. If you're in a diversified portfolio, you likely have a healthy allocation to bonds along with your equity investments. But given the recent financial market upheaval and a spike in interest rates, you might be wondering, why the heck am I having money in bond portfolios anyway? That spike in interest rates has caused bonds to lose some of their value, and that's caused investors to question the value of diversification. Now, we know it would be easy to ask that question if your perspective is only taking into account the last few months. Bonds traditionally are supposed to counterbalance the volatility of equities and give your portfolio a smoother ride. So when bonds don't perform, does that mean this time things are different? Not necessarily so. All investments involve risk, even bonds. It might surprise you that since 1995, nearly 15% of monthly returns have had both negative equity and fixed income returns. That doesn't make our recent experience with a diversified portfolio any less painful, but it also doesn't change the need to hold bonds in your portfolio. Here's a little food for thought. In any given month, the worst drawdown for equities was negative 28%. The worst bonds have historically performed in a month is a negative 6%, and those losses were quickly reversed. We believe as volatility and downside risk increase for the stock market, that makes it even more important to buffer that risk with fixed income. Clearly, the 40-year bull market in bonds is in the rearview mirror, and rates have started back up. But the analysts at LPL Research believe just because the bull market in bonds is over doesn't mean a bear market must immediately follow. In fact, our view is that a lot of factors will likely keep bond prices from persistently increasing. First, investors have a need for safe, reliable income, and today that need is higher than it's ever been before. Second, anytime there is turmoil in the world, there is a flight to safety. That means core bonds, and more specifically, U.S. Treasuries continue to be the best diversifier to a broad-based equity market sell-off. Those are just two of several factors that our research team believes could keep bonds from suffering on an ongoing basis. So ask yourself, what's your perspective? Are you thinking only about the most recent sell-off in bonds? Or are you keeping in mind the value proposition offered by fixed income? Liquidity, equity, diversification, and total return are all valuable properties that core bonds bring to a portfolio. We've often said that time is a great cure for most of the ailments in the stock market. It looks like the same can be said for your bond component of your bucketing strategy or your diversified portfolio. That's the fastest 4 minutes in finance. Enjoy your weekend.